Hey Alex, I got a question.
Yeah, sure.
So about that client that me and you were talking about earlier, the one with the trust fund. Um,
Yes.
so me and her were talking, and she wants so after she turns 30, the trust fund it completely pays out to her the $100,000.
Yeah.
And what she was planning on doing with that is she wants to buy a house with it. And I know you told me that we can try and look into an IUL, but
Yeah.
she's also interested in retirement. So I was thinking, would it be a good idea to do an IUL and an annuity for her?
Well, right now you can't do an annuity with her until she turns 30,
Okay.
right? So that's why
Hmm.
the IUL would be the best opportunity. So Hamza is talking about a trust fund child. So her mother had a settlement where she got a lot of money, and someone had the wisdom and foresight to have her, instead of what spend a lot of money. Apparently she just, she's a drug addict, so she started spending a lot of money. But someone convinced her to set up a trust for her child, her 19-year-old daughter. I guess this is how many, I don't know how many years ago, but she set up this trust, and it's a trust for the benefit of her daughter. She put I guess, over 100,000 in it, right, Hamza? And so the trustee, which is a bank, actually a financial institution, um, will reimburse her for health, education, maintenance, support, and other things, so that she can't just willy-nilly spend it, and her expenditures have to be approved. And then this trust lasts till age 30. After 30, everything will be distributed to her. So it's really, it's a sub trust to protect, um, against a young person frivolously spending money. And thank God that it's also was protecting the mother from frivolously spending her settlement money. Again, Hamza, that was, whoever took care of that was smart. So Hamza asked the question, can we take that money out and put it in an annuity for her to start retirement planning? And the answer is no, because it's an irrevocable trust. And with an irrevocable trust, it's irrevocable. So you cannot do anything about it. Okay. So it is what it is. It's going to pay out um, along the way. So I said, she's 19 years old. And why don't we put together an IUL illustration for her, so we could show her how much money that she can get out in the future. And honestly, within 10 years, who knows, there could be enough money in there to borrow the down payment to a house and continue having the IUL, right? Continue to fund it. Okay. So, like, we're still on my screen, right? You guys still see my screen? Can I hear an amen? Can I hear someone say yes?
Yeah, I see it.
Okay. So
Yeah.
let's do this. Let's just, for grins, man. I'm just going to do it for fun. I mean, we're on the topic of IULs anyway, so this is actually a good thing to do. Two-factor authorization. And she has, like, what, she makes about 40,000 a year in her job, right, Hamza? And she lives with what, her sister, something like that.
Yeah, 45,000 she lives with her sister.
Okay. So she seems fairly responsible. She has a good job, or good, good, whatever that means. I'm not a fan of jobs, but okay. The only thing is that she's bipolar, isn't she? Oh
It
no,
was
depression.
yeah, depression. She
Okay.
didn't say that bipolar.
Okay. Yeah, and that's a big deal. So when they're taking meds, that is for bipolar or depression, you need to clarify which one is it, because one is more favorable than the other. What's her name?
It was Kaylin.
Oh yeah, that's right. It's interesting. I'm just going to put Mary Smith.
Okay.
Oh, and what's the birth date?
September 1203.
Okay, and this would be awesome. She's in Ohio.
Yeah.
Go Buckeyes. Index Universal Life. So I'm a big fan of North American Builder Plus 3 because it has really strong cash value. And in this particular case, it could really do well for her. So here's what I typically like to do is let's just go. I'm just going to go standard health because of the meds she's taken. I don't think it would be rated up, but I always try to do standard health just to be very conservative. They could get preferred, who knows, but I'm not going to assume that at all. Okay, so what I'm going to solve for is okay, so what I'm going to look at is let's see what happens if we put in $500 a month. This is assuming that the trustee would approve $500 a month, but this is an not investment, it's a retirement planning opportunity. And the only problem is Edward Jones is the trustee. So Edward Jones would probably say, well, why don't we write it for you? So you have to be careful with that. Okay, because she's young, I am going to run this. Death benefit option. I'm going to go increasing. Change death benefit. Oh, you know what? Actually, return of premium. Now, I'll tell you why I do return of premium, because a buddy of mine showed me how this could really maximize their benefit at the end. So we're going to pay premiums to age 65. And we're going to start taking loans at and then solve for the income. Let's just go to age 90. So basically what I did here was let's just run the income because she potentially could be dead by 90. Like there's only like a small percentage that'll be alive, but let's just take the income from age 66 to 90. Actually, I think I have to do 64. Okay, I think that's how. All right. And I'm going to just keep everything else the same. So how I ran this is I'm doing standard non-tobacco health. I'm going to go multiple death benefit premium distribution. I'm going to avoid a MEC. That's default. I'm doing paying $500 a month. Oh, I changed the death benefit option to return a premium. And we'll see what happens. I can change it later. Pay premium to age 65 and then setting up the distribution. So let's take a look. It may limit the premiums put in it. We'll see. I think the return of premium option will allow me to put more money in, allow her to put more money in. Oh, it ran. Okay. So let's check out Mary Smith's illustration. I was kind of just, let's speed up to the, I don't go, when I show a client illustration, I don't go anywhere but where the money is. So I show them how they're going to put 6,000 a year. So I'm going to show them there are 3 columns. This is the guaranteed, the non-guaranteed, and the non-guaranteed assumed. And basically I tell them the minimum account value is 2% growth in your cash account. This one's 3%. 5.91% is probably more likely because this is based on the S&P 500 index. Actually, what index are we using? We're using the S&P 500 index, and it's averaged actually 6.5%, I believe, the last 20 years. So it's more likely going to be the non-guaranteed. So let's turn our attention to this 3rd column. So I'll tell her, so year 10, you put $6,000 a year, you have 60,000, and then your cash account value, notice is 66,000, and your death benefit is 202,914. Okay. Now let's see what happens at the end of year 20 when you're 38 years old. You put 120,000 in. Now look at your account value is now 187. Okay, it's growing. Okay. Oh man.
Account value is how much money they can pull out, correct?
Yes, they can borrow out.
Yeah, with the interest.
Okay. So she could borrow out some of that money for a down payment to include whatever else she doesn't use. Hold on. I turned the annotations off. So someone chose to write on the screen. Okay, so now you're 30, 180,000. Now they got 399,000 in their account. So if you doubled 180,000, it's 360. They've already doubled their money in 30 years. So what is that? 100% return on investment after 30 years? Tell me what investment that you could double your money in 30 years. Okay, 40 years. So she's 58, 59. She's put in 240,000. Now she has 762,000. Gee, Alex, that looks like triple her money. Yeah. That looks like 300% return on investment. So she stops at age 64, 65. Okay, so now she has $1 million in her account. So now she gets to take out 115,000 tax-free at age 65 till she's 90. So at age 90, she had the benefit of, let's go down here. These are the totals. She put 276,000 into the account. She had the benefit of $3 million tax-free, and her death benefit at age 90 is $434,000. Let me say that one more time. She put in $276,000 over her lifetime into this policy. She had the benefit of $3 million. What's the percentage return on investment on that? Right? 4, 5, 6. It's like that could be what, 276? What multiple is that? That's a quarter. 300. 600%, 700%. So Hamza, that's what she could do. And that's even after borrowing out 60. See, here's a crazy thing. Let's say she borrows out money for a down payment, let's say 25,000, and then she supplemented, out of the other part of her trust. That's only 60,000 in, anyway, this is if the trustee would allow her to do it.
Yeah. She was telling me how there's like a weird thing where they won't let her take so much money out at once. And they've done it before, and she got locked out of her account and they couldn't spend any of the money for a year.
Well, like I said, she'd have to run it by the trustee of the account.
Yeah.
And explain why she's doing it and what she's doing it for. Right.
Hmm.
It's the trustee is the one that controls it. Now, what they're doing is they're doing it on a reimbursement basis. So she's got to submit probably receipts and what, so she's
Yeah.
going to have to clear it through the trustee, explaining what she's doing. But look, she's making $46,000 a year. I mean, I don't care if this money comes out of the trust or not. It'll be reimbursed later anyway, like the money she's doing this with, right? So
Yeah.
let's just back off. Okay. Let's just say, instead of 500, let's say it's 250. $250 a month. Okay, and let's add a change. Pay 250 to age 20. Okay. At age 21, we're going to raise it to 350 to age 30. Oh. And then age 31 to age 40. Let's go up to 500. Okay, and then 0 at age 65. Okay. So what we've shown is just let's start off small and go big. So let's take a look at what that looks like. Fun with IULs.
Are you able to change how much you contribute after the policy is already in place?
Yes. These illustrations are just what if scenarios. Okay. She can make whatever changes she wants. She can put in or she can not put in. It's flexible. That's the beauty of IULs. We're just showing her what would happen if. Okay. Okay, so you can see the scenario 3,000 and then it goes up to 40. Oh, I know what happened. I think it had me. I think there was a minimum amount. Yeah, there's probably a minimum amount I had to put in. So that's why I went up to 4,200. See, it lets you only do what you can do, what you should do. So the scenario I put together in there was probably not going to let the illustration run properly. But anyway, just look at how much. Oh, this is messed up. Huh. She can stop making premium payments at age 40 and just let it run. She'll make 65,000 a year. Okay, that wasn't exactly what I wanted. I did not intend that. Oh, 40. Oh, 40. Oh, I see what I did. Oh, yeah, I did. Okay. Let's drop this down to okay. Now let's run it. I had to erase that because it just drives me nuts. Okay. Annotations, man. I need to turn those off every time. So drum roll, please. Anyway, okay, you can see how it gradually, moves up. Yeah, 90,000. That's still pretty good, right? There's a little overlap there. Probably would have should have done I should have stopped at age 65 and started I should have stopped it at age 65 a year earlier. But yeah, that's okay. So you can see the benefit, 246,000 to get 2.3 million. Again, pretty cool, right? And at age 90, she has $337,000 of a death benefit for her, for her children. Okay, presumably. Is that cool? I love running IUL illustrations because it really shows, possibilities. And her situation, it's unusual. But even if it wasn't her situation, if she's making $46,000 a year, I would say, look, like my son Athen, who's a pilot now, I got him to apply for an IUL, putting $5,000 a year in it before he got into the Air Force. Like he was in ROTC, right? And he was making money in ROTC because they paid him to go to school because of our ROTC scholarship. I got him to put $500 a month into an IUL before he became a pilot. If he applied now, the insurance company will look at him because he's in the military and he's got pilot. So I did the smart thing and I got him an IUL before. He puts $5,000 a year in it, and I think by that time he'll have over $150,000 a year in tax retirement. Okay. But anyway, so what I should have done here is I should have 64. That's probably what I should have done. Anyway, so this is a really great scenario. And a 19-year-old has the benefit of compounding, interest compounding, right? That's the reason why she can have over six-figure income. I don't know how she can live on six figures, right? She needs to get into insurance, man. She needs to be an agent. Anyway, so do you have any questions, Hamza? That's what I would do for her.
My last question, I noticed when you were showing the illustration towards the end, like 65-ish, the account value, like the money that can be borrowed, was more than the death benefit. So what if somebody borrows like $1 million towards 65 and then don't pay it back, but their death benefit's only, let's just say, 250,000?
That is not possible. Let's take a look. Show me where that is the case.
So the
Right
last,
there.
yeah,
Wow, that's an interesting quirk.
would they allow the person to take out more than their death benefit is?
Now, this is what should have happened because of the type of policy this is. There should be a corridor of insurance that goes above, like, for example, right here. Wow, I'm going to have to ask them that. No, they can't. They can't borrow more than what the death benefit is because the death benefit is what pays off the loan. That's
Why is the
interesting.
death why is the death benefit actually decreasing? It hits a million and then it starts going down.
Because it reflects the money that's being taken out as a loan. Oh, I know what's going on. Okay, so the money is being taken out as a loan, but the money is still earning interest rate. So while the death benefit is decreasing to show that the loan would be paid off, the money that's accumulating into the account continues to grow. So that is actually why the account value is more than the death benefit. So all this money that is being loaned out is still earning interest in the policy. That's the other feature of these policies, is that even though they're borrowing money out, they're using it tax-free. It's a loan. So that's why the death benefit goes down, because the death benefit would be used to pay off the loan, but the account value goes up because it reflects the money that was borrowed out that continues to grow interest rate. It's just how IULs work, which is kind of cool, actually.
Okay.
Yeah, I mean, it sounds crazy, right? But that's how IULs work. The money still earns an interest inside the policy, even though you're taking money out, and you can use it for whatever you want tax-free because it's a loan. The IRS can't tax a loan, but it's a loan to yourself, and you don't pay it back. The death benefit pays it back should you die at any point. Okay. Is that crazy? It's really crazy.
Yeah.
Like, for example, dude, if she took out some money to borrow so if she took out some of this 41,900, to borrow against, this would still go up, and it's not going to go up as much because she took money. The death benefit would be reflected in the death benefit is what would happen, but the money would still continue to grow. So, so that's a great, see how I fixed the overlapping situation here. Is that cool? I think it's the coolest thing. Anyway, so she's a great case to show how someone that is young, like all you people that have kids, young kids, you should be doing this for your children. Like, I'm not kidding. Let's dial it back. Okay. Let's say she was born in 2022. Okay. So she's age 0. Okay, everything's the same. Parents are funding it. And let's just do the same thing here. The parents are gradually moving the money up. In fact, yes, let's just say 0 through age 1. Let's say 22 to 45, 46 to 65. Say 500. So now they got interest compounding to the max. Let's take a look. Oh, it's going to mech it. So it's not going to let me put as much in, I think. I broke the system. Yeah, I think I broke it. No. So let's do this. Let's change. Let's go increasing to age 64. That should give it enough room to run. So increasing death benefit means that the death benefit will remain the same. Starting death benefit will remain the same throughout the entire to age 64, and then it levels off. I'm not going to get into it because then I'll have to go into an hour-long seminar on how that works or why that is. let's just say it allows us to put more money into it to maximize the benefit to a younger insured. Yeah, so we start with $1 million death benefit. Let's see what. Oh, why are we taking money out at age 46? Well, I guess you could show that you take money out. Okay, let's take a look at. Oh, yeah, you have to like think through everything. I'm just kind of going through it quickly because it's 10:05 already. I'm surprised there's still 30 people on here. I'm impressed. This is important though. Like when you start learning the power of index universal life and tax-free retirement, tax-free, it'll blow you away with the benefit, because this is really literally you can actually go take the income all the way for the rest of their lives. If you can't, it's hard to compare a 401k because 401k runs out. IULs won't. And it's tax-free, where 401k, they have to pay taxes on it. So $1 million death benefit, 6,000. Gosh darn it. Why is it? Okay, I'm going to make it simple. By the way, I would recommend y'all playing with the illustrations because this is how you learn how IUL works. Play with different premium amounts, see how it affects the death benefit and the payouts. There's probably something I'm not doing right here. Like I didn't start from scratch. I should have started from scratch and just built everything up. Okay. There we go. Okay, she waited a year. 302,000 a year. So let's look at the total benefit. She put 390,000 in. She got 7.5 million out. You tell me what investment, and plus she gets death benefit of 1 million, $1 million death benefit to her kids. And oh, by the way, she got living benefits. So if she became critically ill, chronically ill, basically it works like a terminal illness benefit, $1 million, 480,000 chronic illness, critical illness, 50,000 for all the years. So this could be a, really good long-term care policy. This rocks. See, so the younger they are, the more benefit they're going to get. So anyway, gang, anyone have any questions about that? It's a great policy. So Hensa, find out, tell her that we have a retirement planning opportunity for her. Have her find out if she's able to take money out on a monthly basis to invest. Basically, just ask that question. Have her ask that question. Okay.
Okay. Yeah, I'm gonna see her tomorrow, so I'll make sure I ask.
Okay. Cool. All right. Thanks, gang. I hope this made sense. There's so many cool things that I want to teach you about IULs. I will probably do a seminar, maybe on Saturday morning. It'll probably take a couple hours, but to teach you how IULs work, like lift up the hood and let's look underneath it. By the way, this would be nothing, you would never teach your clients this stuff, but I want you to understand why the illustrations work the way they work. And oh, by the way, that scenario, how much would Henza have made? So just the last scenario that I showed, he would get paid to target premium. So the target premium is 51.53. So I think it's 88% commissionable premium. You only get paid on target times 0.88. Let's say Hemza's on, let's just say 55.55. So that's $2,500 if you're at the 55% commission rate. So $2,500 is not bad. It's pretty decent money for an illustration like this. So, okay. Anyway, good stuff. Thanks everybody for plugging in. God bless. And look, let us know, man. Show us your plane ticket, and we got you a ticket to the Miami conference. And again, I hope I did a good job at explaining you the importance of you being there. I mean, I hope I did, because anyway, rock on, man. God bless everybody. We'll see you later.